Good afternoon. Sorry to disappoint. I am Daniel Craig, but not that Daniel Craig. You should have seen my wife's face the first time we actually met in person after online dating. No, just kidding. So this talk is why the IRS loves your SaaS business. Admittedly, probably the most boring talk title here this weekend. But 56 of you voted for it. So actually only 53 voted for it. I won't tell you how I got the other 3 votes. But why the IRS loves your SaaS business. Essentially, just a little bit about me. Run a outsourced accounting firm called Bloom, and we do all things accounting and finance for SaaS companies. And I wish I could get up here and tell you that we had some really cool startup story, like we began in our grandmother's basement or survived in a garage eating top ramen. But I think our story is kind of cooler than that because our business started out as the entrepreneurial dream of 2 brothers, and today we're actually living that dream out by helping other entrepreneurs pursue their dreams as well. Isn't that a great stock photo, by the way? No, just kidding. That's actually us. So real briefly, just to give you a little bit of an idea why you need to be tuned into some of the tax regulations that are coming out over the next little bit for SaaS. SaaS is approaching 30% of total enterprise application spend. So it's an industry that's going to be getting more scrutiny and awareness. I think we can plan on that. And so a couple of regulations that I think you all should be aware of, and hopefully this will be helpful. Reason number 1 why the IRS loves your SaaS business. First of all, tax revenue. Obviously, the IRS loves revenue, and you need to be aware of this new regulation, set of rules on how the IRS is going to have you report your revenue to them. How many of you are familiar with ASC 606? Okay, great. Glad we're talking. So this is a new set of rules that basically determines how you report your revenue to the IRS. It's called revenue recognition, and that basically means in the world of accounting, if a customer pays you $120, you can't claim that $120 as revenue until you've earned that $120 by delivering your product or service. So some of you are thinking, okay, what's so complicated about that? Well, it's not complicated if you get your revenue and deliver your product in the same month. But if you get your revenue in January and deliver your product for that revenue over the next 12 months, you actually have to, quote unquote, earn that revenue over the next 12 months. That's what the regulations say, and that affects how you report your revenue. So this drops right down to the bottom line of your IRS tax return as a company. It determines how much revenue you report, and as a result, how much you pay in taxes. So a couple of things that you need to know about this regulation. It's effective for public companies January 1, 2008, and private companies January 1, 2018 and 2019. One last thing about this regulation, it only applies to entities that file taxes on an accrual basis. So if you're cash basis in your filing, you actually don't have to worry about this. If you're accrual, then you do. Okay, if you want to get more information about this, get these slides, bloomaccounting.io/MicroConf. You can get this information. The next reason is a little more exciting. It's job creation. How many of you are familiar with the Section 199 deduction? Okay, a couple of you are. Essentially, this is a deduction to incentivize manufacturing jobs here in the U.S., the creation of manufacturing jobs in the U.S. And believe it or not, SaaS companies can actually, in some cases, qualify for this deduction. So essentially how it works is you can, if you qualify, deduct 9% of qualifying manufacturing income, like your subscription sales, not professional services. You can deduct that for your tax purposes. So quick example, if you have $100 million in revenue, $1 million in revenue, $900,000 in expenses, $100,000 net income, instead of paying taxes on that $100,000, you can deduct 99% of your $1 million, which is a $90,000 deduction, makes your taxable income $10,000, and if you're in the 25% tax bracket, you're paying 25% on $10,000, only $2,500 instead of $25,000. So it's, again, if your CPA is not talking to you about this deduction, be sure to talk to your CPA about this deduction and see if you qualify. Essential qualifications: you have to sell an on-premise version of the same software or have a competitor who sells an on-premise software that is substantially identical to your SaaS product. So those are a couple of things to be aware of. And I don't know that I am seeing the timer here. So there we go. Okay, great. Wrong screen. So that's a couple of things to be aware of on the tax regulation side of things. Again, you can get the info there. But in a few minutes that I have left, I want to talk just a little bit about financial management from a broader perspective. And there's been a lot of talk about profitability this weekend, and I just want to share a few things that we're finding as we work with our clients, and maybe they'll be helpful to you all as well. But I think we would all agree, as we think about financial management, that the primary goal of financial management is to maximize profit, right? You want to, use your monies in a way that at the end of the day you have a profit. We get that. But what's interesting is that as we actually look at the day-to-day way in which we manage our finances, it often doesn't match up with that goal. For many of us, managing finances is about making sure we have enough money in the bank, or making sure we can, run a P&L so that we know what our tax liability is, or budgeting revenue and expenses. But what's missing from all of these approaches to financial management is any real focus on profit as the driving force and consideration in our management of finances. And essentially what this does is it puts profit in the leftover category, just what's left over after we get our revenue and spend our money, instead of putting profit first. It essentially is a paradigm of thinking about profit where profitability defines our approach to our MRR goals and our expenses, instead of having our MRR goals and our expenses define our profit. So essentially, just to put it in a nutshell, the paradigm that I want to suggest as you think about managing your finances is basically this. Financial management is the discipline of predetermining your profitability. Financial management is the discipline of predetermining your profitability. And essentially what this means is that not come up with some fake profitability goal and throw your app at the wall and hope you hit it, but actually defining at the very outset what your profitability goal is and reverse engineering your business in such a way to reach that goal. It means that we have to get rid of the idea that, hey, I'm going to build my app and wait till my revenue stabilizes and my product stabilizes to think about profitability. Think about it from the very beginning. You say, okay, well, how does that work? Here are 3 basic keys to the discipline of predetermining profitability. And just to give credit where credit is due, a couple of books that speak to these ideas, and I've drawn some of this from these books, Simple Numbers, by Greg Crabtree, and Profit First by Mike Michalowicz. Key number 1 is to pay yourself a market-based wage. And this is crucial not just when you have the money to do so, this is actually crucial when you don't have the money to do so. Now some of you are thinking, okay, wait, how do I pay myself a market-based wage if I'm a startup and I don't have the cash to do so? Well, here's how you do it. 90% of entrepreneurs actually underpay themselves. And so what you got to do to figure out your market-based wage is essentially ask the question, if I were to quit my startup today and go hire on as a dev at XYZ software company, what could I get paid? You come up with that number. Say it's $80,000. Then you go to your profit and loss statement. And here's what you don't do. If you're an early stage startup, really early, say you're generating $30,000 in revenue, you say, okay, hey, I can't pay myself 80 grand. I'm going to pay myself 20 grand. I have $5,000 in other expenses. Hey, cool. I have a net profit of $5,000. Actually, no, this is how you have to and how we have to begin thinking about our market-based wage. Go to your P&L and look at it this way. Revenue is $30,000. My salary is $80,000. 20%, 20 grand of that is a cash payment, and the other 60 grand is sweat equity investment into my business. But it's absolutely a line item on my profit and loss statement, so that when you get to the bottom, you realize it's a total gut check. I'm not making 5 grand. I'm actually going into the hole $55,000 this year. And this isn't a fun exercise, but it's a crucial exercise because it gives us clarity on where we are in terms of our profitability so that we have laser focus on where we need to go. Jason Lemkin puts it this way: working for free or too cheap has another downside. It gives you an excuse. If you're taking an expensive salary, you know you have to deliver. So great quote there. Second key, define done. What does this mean? Essentially, in businesses, and I think particularly in software development, it's a constant temptation to keep tweaking the product. And when you keep tweaking the product, you spend more, your costs accumulate, and you really lose sight of profitability. So defining done is basically answering this question: how much will it cost me to get to 20% profitability? At the beginning of developing a product or at the beginning of developing a new feature set, ask yourself this question: how much is it going to cost me in terms of all my costs, including my sweat equity investment, to get this project to produce 20% profitability? And then say, okay, do those numbers make sense for me? And some of you might be thinking, okay, I don't know if I can calculate this number. How do I do that? Well, I think it's important to, because if we're not calculating this number, basically what we're saying is I'm willing to put an undefined amount of money for an undefined amount of time into a project with an undefined result. And I think that's kind of scary. So number 3, enjoy regular profit distributions. This is key to getting a profitable mindset. You enjoy the distributions. You want them to keep coming. And Jason Fried has a great quote on this from Basecamp. He says, profit protects you from your ego. Profit creates reasonable borders and boundaries, and that's a very healthy thing, especially early on. So, another thought is profit is using the resources God gives us to invest it back in our family and our community. So it's not about being a big, fat, selfish pig. Lastly here, this book, Simple Numbers, Straight Talk, Big Profits, has a lot of great content, and I've talked with Greg Crabtree recently, and he's actually agreed to do a series of video chats applying these concepts to SaaS directly. So if you want to get those, I'll be sending those out over the next few weeks. bloomaccounting.io/microconf, and happy to share those videos with you. Hope this was helpful. Thanks.